Welcome back to Trade Links, brought to you by NatWest. My name's Tim Phillips. In the world of geopolitical uncertainty, shifting trade alliances and tightening financial conditions, and if you are a regular listener, you know that's the world that we inhabit at Trade Links, both Treasury and trade finance functions are on the front line of balancing risk management and growth. Get it wrong, and you're facing funding shortfalls, regulatory breaches, delayed shipments, unexpected losses. So, how do we get it right? In a bonus episode this time, we've given Scott and Aastha the day off, and in their seats are Naresh Aggarwal, Associate Director, Policy and Technical at the Association of Corporate Treasurers. Hello, Naresh.
Hello, Tim.
And Rowan Austin, Head of Trade at NatWest Group. Hello, Rowan.
Hi, Tim. How are you doing?
Good, thank you very much. So today, we are discussing how Treasury and the commercial side of the business can work together, and what happens when they don't. So Rowan, to you first. In our last episode, Scott and Aastha, they were discussing how the tariff moves and all the economic protectionism we're seeing are forcing companies to restructure their supply chains. How is this going to impact the Treasury function?
The simple answer is in a big way. I think it's worth stepping back a little bit and mentioning some of the topics that Scott and Aastha have talked about in the previous episodes.
Oh, yeah.
Specifically, it's not just about tariffs. I know that tariffs are really big in the headlines at the moment, but the reality is the world of trade is changing significantly with the hugely disruptive geopolitical environment. Non-tariff barriers are a big issue as well that we shouldn't forget, particularly in terms of how it impacts our clients, and the growing weaponization of trade, which is a theme we're really seeing across the wider market.
Mm-hmm.
We are living through the great age of supply chain disruption. We've seen the COVID pandemic, we've seen Russia invade Ukraine, and all the impacts we've seen on supply chains across the world. And so we've seen some of that nearshoring, friendshoring, and now reshoring of supply chains. And that's having a really big impact across the world on how companies operate. If we look specifically on the impact of US tariffs, so that is focused specifically on US businesses. So if you're a US business or if you're a multinational business operating in the US, you're going to have to be paying tariffs, import duties at a raised level compared to where we were previously. The big challenge there for Treasury is from a physical perspective, somebody's got to pay those tariffs.
Yeah.
Now, the importer in the US is making the physical payment of the tariff. So we need to look at Treasury and the impact of working capital for making payments of those tariffs. Tariffs are now at the highest level since the 1930s, so at historical highs. And in June, news quite recently was that the US Treasury took in $28 billion in terms of revenue from tariffs themselves, 3 times the level of the previous year. So that cash is coming from somewhere, and that cash is coming from the US importers. Now, in terms of the pricing mechanism itself, it's not really as simple as just saying the importer's paying and therefore the US consumers are paying. There's a bit of a mix there because it's also coming from the supplier's margin and the importer's margin. So it's a wider mix. But in terms of Treasury, they've got to find the cash to pay this. So that's a working capital impact. We've also talked a little bit about reshoring of supply chains. And a big element of what Donald Trump is seeking to do is encourage investment in supply chains in the US. Lots of headlines about billions and billions of dollars of investments in the US to focus on localized manufacturing. Now, if a business seeks to do that, and there's been lots of headlines of big businesses that are looking to do that, that means long-term infrastructure spend. These are sort of 5, 6, 7-year projects to build local factories, build local manufacturing capability. That takes a lot of money. And that's when they'll come to the treasurers to work out, how do we finance this? How do we actually get this out of the door?
Naresh, does this line up with what your members are experiencing?
Very much so. I would echo a lot of what Rowan has said. To me, this is not new, the tariffs. I would definitely agree that this is a trend. If I think about the 2010s, we had a very benign economic macro environment. It was all just in time. We were getting goods shipped over from many, many countries, and everything worked very well. There was plenty of liquidity in the system for most organizations. What COVID-19 did, as we know, is made a sudden change to a lot of what we assumed was business as usual. And so this is not a sudden change for a lot of Treasury folk. This is more of the same. But I think one thing that's really different that is for a lot of treasurers is the speed of change.
Mm-hmm.
Whereas previously in 2020, 2021, 22, people were thinking about reshoring, friendshoring. These were long-term plays. Where do I strategically change my sourcing to actually somewhere closer, where things like the Suez Canal, issues around the Red Sea were less impactful for the businesses. And I also think it's the uncertainty that comes from it or drives it. I don't know which one it is, but it's that uncertainty that I think is probably the most pressing thing for a lot of Treasury folk. One of the implications is in the short term, we need more money, whether it's because we have to pay the tariffs initially to the Treasury or because our supply chains are becoming more stretched. The reality is, for a lot of organizations, it's about finding money. As we know, there is no one set type of treasurer or one type of business. So for some businesses, the well-rated, the large organizations, finding short-term liquidity, I assume from the likes of people like Rowan, is still not a problem. But it's when you get down into the smaller, the SMEs, the more niche players, their only business is buying helicopter blades from a factory in China and to sell them on to the US. If that's all you do as a business, you've got a real problem. Not just because you're heavily impacted, but also whether the banks are going to lend to you given the narrowness and the precariousness of your business. If you're a multinational global player, you've got some form of diversification going on with your business, so the lending should not really be affected. So I'm always very hesitant about saying for treasurers it means this, because they're all different and they're all impacted in different ways. But if I think about some of the more difficult challenges for treasurers, it is a combination of needing money, needing it quickly, and the lending appetite of organizations to lend to those types of businesses. Now, one of the things we've seen is definitely around cash forecasting. The key job for most treasurers is to do cash forecasting. My 9 years at PwC, I still found organizations didn't bother with cash forecasting. If I've got enough cash and my margins are decent, who cares about how much cash the business is throwing off? These are all trade-offs, Tim. If I'm spending time on cash forecasting, I'm not spending time doing something else. So actually, for the business, it may be better looking at margins, expanding into new markets. But we know from COVID-19 is that changed from most organizations. Boards, whatever type of organization they were, however big they were, suddenly said, I need to know where the money is. And I still remember talking to one very large SME. She went to weekly forecasting. I saw her not that long ago. She's still doing weekly forecasting because the board have got some degree of comfort from seeing the numbers come through. She's created a great discipline across the organization, a focus on cash, not just on profitability. In terms of cash forecasting, it's definitely for some organizations made it much harder because I don't know what currency I'm paying in now. I don't know what my payment terms are. That level of uncertainty means I need more liquidity on tap, more contingency facilities available to me. And if I don't have that luxury of being able to draw on that, I think businesses are in a difficult place because it's not enough to say, improve my cash forecast, because sometimes you can't.
Yeah.
We know we live in a world where customers say they're going to pay you tomorrow. I don't know what your experiences were, but sometimes they'll pay you the next day, the day after. Maybe they're struggling themselves. The certainty has gone. If you don't monitor at least your working capital, others in your value chain who are managing working capital will take advantage. If you're not monitoring it and looking at payables and receivables together, better businesses are. So I think working capital is definitely constrained. And times like this, it requires an even greater focus on just knowing what it is.
We're talking about risk, heightened risk. And organizationally, how do you handle that? Do you have to revise your risk appetite, your attitude to risk?
As a bank specifically, absolutely. So we're very active in terms of how we manage and monitor our own cross-border risk and also how we support customers in doing the same. So, our customers expect the right kind of advice and knowledge from us in terms of supporting their cross-border trading. We've touched a little bit on what's happening with supply chains and the redistribution of supply chains. And a good example there is if you're finding new suppliers in different markets, how are you managing the risk of trading with those suppliers? And what kind of payment mechanisms are you managing? What kind of terms are you managing those suppliers on? And that's really, really important to manage that effectively. So if we think about how supply chains have evolved and how typically large corporates have worked with those supply chains. Typically, the more globalized supply chains get, the more payments tend to move to open account. So without necessarily using any payment instruments, pretty much just like you'd pay a local supplier, because the resilience of those supply chains and trust builds and grows, and you don't feel that you need to mitigate or manage that risk. However, the current environment we're seeing now, where you're getting much more disruption and turbulence, and if you're engaging with new suppliers, then you need to think about the risk of doing business in that country and how you're going to mitigate and manage that risk. And it's not necessarily just about the credit risk of working with a new supplier in a new country. We had an example recently where we saw a client look to set up a new supplier. The supplier asked for a standby letter of credit. And we looked at it and just thought, there's something wrong with this. There's something that doesn't quite look right. And we did some delving and we unpicked the whole thing. And it was a fairly significant and very technologically advanced effort at fraud. You've got to be managing your risk in the right way. And it's not just about credit risk, it's across the whole value chain. So also watch out for that fraud risk.
There's a lot of education that needs to happen within businesses, partly because, as you say, they're maybe expanding to new environments. But we know when times are tough, level of fraud is going to go up. And I think that for some of our members who have lived during times of benign economic growth, there needs to be a much sharper focus around how to help businesses avoid some of these things. And I do think that the risk appetite for some of our lending institutions just isn't appropriate for where we are now. This aversion to taking risk and supporting clients with risk is not helpful. And whether it's a combination of education or monitoring risk or supporting risk more, I think lending institutions have got a long way to go to help, especially those smaller organizations that don't have the resources, don't have the experience, don't really understand the sophistication of the fraud. I mean, I'm staggered. I was at a conference last year. Somebody talked about how a huge ship of goods suddenly disappeared. I'm going, that's a bloody big tanker.
Yeah, they don't disappear.
They don't disappear. And yet, somehow, this thing that you think is covered by all these satellites and GPS and stuff, their stock managed to change from what they said it was to something completely different and valueless. And I think a lot of our members are just not fully aware of just how widespread and how complex and clever this stuff can be. That we live in a world where the devil is in the detail. That shipment that you said was coming from India to Nottingham, yes, you got a bill of lading from the port in India, and you assume that ship is going to arrive in Southampton and on a truck up to Nottingham. But that confidence can sometimes be misplaced.
I agree, Naresh. I think the banks do have a responsibility to work with clients to help them understand where the risk is and where it can be mitigated. Also, there is, and sometimes this can be a tough conversation, if a client comes to us with an idea on a cross-border trade to say, we don't think this is doable because the risk is too high, or it's only doable if you put in place certain mitigation techniques to do it. The responsibility is on us to help educate those clients, as well as within the clients to understand the devil in the detail and the impact of the physical logistics, because that's really important. And that's how Treasury and the front line of the commercial business can work together and to operate.
We need more help to work out what are the right questions that we should be asking of yourselves, of the suppliers, just to make sure we are getting to the nub of the question.
Rowan, even if your business customers are educating themselves and asking the right questions, in this circumstance, are you more hesitant to fund international trade?
So banks are risk businesses. As we know, you have to take risks to be a successful bank. That risk has to be managed and monitored and mitigated appropriately to continue that success. Because if you lose too much, you're going to fail. It's really important for us to be aware of the risks we're taking, we're encouraging our customers to take, and how we can actually manage that. I think key is we need to monitor it. Yeah, we're in a different world than we were sort of 5-6 years ago, pre-pandemic and pre-invasion of Ukraine. The market, in terms of the pricing of risk, will also change significantly and shows that. Generally, where there is a bankable deal or a deal that can be supported with a trade finance instrument, there's a price around that. Is the price worth paying? Because that will typically identify how risky that market is.
As you said, we're entering a new world, a new norm. And I'm often worried we're still using historical paradigms in terms of identifying risk, measuring risk, managing risk, both from a corporate perspective, but also from a lending institution perspective. There are a few organizations that I've come across who have looked at strategically how they move their business and their approach to risk from a world that we had to a world that we know will be unstable. Geopolitical relationships will move like tectonic plates. Whatever happens in the US, we know this genie is out of the bottle. And I remain unconvinced that treasurers and businesses are ready for this new world rather than just I'm adapting to short-term FX volatility, short-term tariff volatility. I mean, the weaponization of tariffs. We've seen it before, but at a much lower level. Now we're going to see it with a ferocity we've never seen before. This is something we need to be ready for as a business, not just for 2025 and get through this year. But this is a real change. And I just don't think we have worked out how we change appropriately to adjust to that new world.
I do think that corporates have learned a huge amount from supply chain disruption over the last 5 years or so. Not just strategic reshoring, friendshoring or nearshoring as we've spoken about, but actually how to manage your supply chain risk. Supply chains are like light bulbs. You walk into a room, you hit the light switch, and you expect the room to light up through the light bulb, right? But you don't really notice it. It just happens. But you notice it when the room doesn't light up. Otherwise, you're floundering around in the dark. Why is that? Is the light bulb broken? Can you find a replacement light bulb? Is there no electricity? What part of that supply chain is not creating that thing to work that you just expect it to work? But post-COVID and Ukraine and the focus on supply chain resilience has been much more acute. This has gone right up to board level. When supply chains work, no one bothers about it. But when they don't work and you can't get your product to the customer to generate your bottom line, that suddenly becomes a board problem. And that's why the risk of supply chains has gone right up the agenda, which means that you've got corporates looking much more in terms of resilience rather than purely looking at cost. Do you have strategic suppliers? If so, what happens if they fail? For whatever reason, and how do you find a replacement? What would you do if that happened? How can you model that supply chain? And what happens if you have single points of failure? It's really, really important, and it's become increasingly so.
I was lucky to be in Dubai earlier this year. Their mindset is really fascinating because a lot of this is a trading economy. But the way in which they look at the challenges that we've talked about already is these are just obstacles in our path. To go from A to C, I used to go via B. Now there's a big impediment at B. I need to find another way. Oh, look, I found if I go from A to D to E, I can get to C. And they just see that as part of business as usual. They don't see these things as fixed in the way that I think we have historically felt in a lot of our organizations. So I think part of the change that we need to be encouraging is a change around mindset. It's a horrible thing to say, but don't look at some of these conflicts from an economic perspective as, oh my God, but actually, okay, I've got a roadblock in front of me. I still want to get to a particular destination. What are my options and my choices? And that's the skill that I need to learn, that flexibility and agility. But it's not panicking when you get that roadblock, because we will continue to see new ones appearing. Having spoken to people there, I do wonder if they're better equipped for this next new world order than we currently are in the West.
We've been looking at the risk from the outside. After the break, I want to talk to you about how organizations deal with this internally. Internally, the Treasury function can sometimes be in conflict with the rest of the business. Naresh, what is the risk if culturally this is the expectation of what Treasury is?
I think that's a great question. And I think there are still treasurers who think the way you manage risk is to eliminate as much as possible. And I think, as Rowan said at the very beginning, the banks are here to manage risk. And as businesses, most people come to the conclusion that the only way to make money is to take some risk. Don't put it all on the 330 at Kempton Park. Put risk mitigation tools in place, but you have to take some risk in order to make some return and some profit. I think that a lot of the words we use when I look at job descriptions now, there's a lot of phraseology around business partnering. So I think there's a real encouragement by organizations, whether it's coming from the CFO, it's just the nature of the businesses to reduce these silos and for organizations to work together. But I also think there is a healthy degree of conflict that should be recognized within the business. Because ultimately, as an ex-treasurer myself, I remember having arguments with a sales director. For him, any growth in revenue was brilliant. For me, it's like, oh my God, you've just increased sales to this one customer by a factor of 10. And I wasn't really happy about the credit risk before. And he's going, well, I'm the one paying your bills. Right?
Yeah. You're a cost. They're generating the revenue. Yeah.
And as he told me frequently, he was doing all the hard work. And it took me a while, and it was early on in my career, to realize that actually there needed to be that healthy tension. And I remember saying to the CFO, don't be upset that we have arguments, because we both recognize we need the same goal, but he needs to recognize the value that I'm adding, and I need to recognize the value that he is adding. We shouldn't assume and expect that we can all agree on everything. And sometimes it may require a CFO or someone else to adjudicate of these two options, which one to go with. I'm a big fan of Ted Lasso. And one of the things is be a goldfish. If you lose a battle on a particular option, live with it and move on, because who knows what the right outcome should have been. Somebody just needs to make a decision. So to me, it's about being informed, being constructive. Say to Rowan, I think you're wrong, right? For these reasons, I think the risk is too much for the business. To listen and then still think Rowan's wrong. And then if we can't agree, somebody else has to adjudicate. But it's that healthy respect and healthy tension, I think, is quite important. If we all agree on everything, there's a real danger. I'm from Nottingham, so we're just going to source everything from Nottingham. That's not always the best thing.
Rowan, not all tension is healthy tension. In this scenario, how do you make sure that the tension is healthy?
I take Naresh's point that getting that tension, getting that conflict towards a healthy outcome is absolutely critical. And it's about adding value. Naresh has mentioned it, and I think covered it really well. It's about both sides adding value, and also the front end of the business, the commercial side of the business, recognizing the value that Treasury can add through financing, through risk management, through advisory. I think there's been a real transition around the migration, the move of Treasury from being an old school accounting function that just adds up the numbers and doles out the liquidity and manages the cash, to an enterprise partnership model. You're advising the businesses in terms of how they can operate, how you can add value to that sales function, that procurement function. One example to call out how treasurers can work with the front end of the business is in export credit agency financing. And we see those, they're large, big ticket, often long-term infrastructure deals. So it could be, for example, a defense client selling fighter jets to the Middle East. These are long projects. They're very expensive. And you can have an export credit agency which guarantees a facility for the buyer in the Middle East to actually buy the equipment. What that means is that you need a partnership between the treasurer and the sales function to put together that contract and that financing package. And that's a great example of how they can work together effectively to make something happen. So the business recognizes that to make this sale, we need that facility in place for the buyer. The treasurer is responsible for putting that in place with the group of banks, with UK Export Finance, to actually make that transaction happen. And that is a classic example of how you've got benefits on both sides and a clear benefit to the business through that partnership model.
And I also think it has changed. If I think about the last 35 years that I've been in Treasury, one of the things that always was a complaint for treasurers was, I should have been brought in on the deal earlier on, because if I had been, we could have used a different subsidiary, a different joint venture vehicle. We could have looked at getting some export finance in place. I generally do not hear this very much anymore. So I do think that organizations have a better understanding, I won't say perfect, but a better understanding of what treasurers do. And we'll use the word again, the value that we add, and the fact we're a necessary part of it. Business knows that if they don't involve us early on, and right at the end of the deal, they go, we need a bank account in India tomorrow. And you go, oh my God, Rowan, can you help me? And Rowan goes, it takes me 2 weeks to do it. Somebody, not me as treasurer, somebody else in the business is going to have to go to the CFO and say to her, we have a delay. Naresh hasn't opened the bank account. When was he asked? Yesterday. Why didn't you bring him in earlier? Somebody else is going to get a telling off. treasurers have managed to explain in better detail the value we add to the business and to be involved at an earlier stage in some of these discussions, negotiations. We're not there to go, we don't want to do this. We're here to listen and to go, oh my God, this is going to be a really complex deal. I need a month to go away to my financing group, banks, etc., and go, what options do we have? How much is it going to cost? Is it doable?
Early engagement, absolutely critical. Cannot overemphasize it, because at the end of the day, Naresh has got to approach the banks and bankers to say, I need something, how can you do it? And that early engagement is so critical. So we really, really encourage all of our clients, particularly we're talking about cross-border risk and the changing world we're living in. If they're engaging with new suppliers, new buyers, talk at the earliest stage about how you're managing those payment mechanisms, and therefore talk to Treasury about how that's going to happen. Is it trade finance instruments? Is it going to be through an open account? How are you going to manage the cash? Are you going to need that bank account in India?
How do I price it?
How do you price it? Exactly.
Do I have to add another 50 basis points, another 3%, or is it open account pretty cheap?
Critical.
This sounds like you've been down this road before.
Very painfully in the early parts of my career.
We're in a very rapidly changing environment now. If you have people who are used to dealing with a static environment, is it now the responsibility of Treasury to devolve more autonomy to other parts of the business in this?
So I'm going to pick on one of the words that Rowan used, which is the word trust. In that very unhelpful phrase, it depends. It depends how well I trust my colleagues. We live in a world where we know when organizations need to be agile. We also know that organization failures continue to happen. Part of what this requires is trying to find the balance around risk and reward. And I'm often reminded of the value at risk. How do you try and quantify a whole range of disparate elements of risk from a currency perspective, especially? And I think we need to apply that in a business environment as well. So if it's somebody new in the business that is running procurement who I don't know, I'm going to maybe trust but verify whatever they do. If they're operating in a country we've used before with customers that we, as a group, we've used before, then my level of risk, I think I'm going to feel is much more comfortable. But if it's all new people, new organizations, new currencies, then I'm going to want to have a much greater oversight over what they're doing. So I don't think this is about one rule sits for all. I think this is about trying to apply different levels of risk and attention across the organization. And that requires a lot of skill, not just visibility of what's going on. It requires understanding people, because it's all very well me telling you what you can do, but do I actually trust you've heard what I've said and you will do that? Where we've got KPIs that are maybe at conflict or at least not compatible, I've got to be mindful that Rowan's measure of success is at the best different to mine, at the worst in conflict to mine. And if it's in conflict to mine, that doesn't mean it's wrong, but I just want to know what he's doing every day.
I strongly believe that the tone from the top is really, really important. And when Treasury functions and businesses get working capital right and how they manage resources across the business, that tone comes from the top. The clients we've seen that launch successful working capital management projects, that tone comes from the top, and the KPIs are driven and are often externally monitored, whatever they might be, in terms of cash flow forecasting, cash flow availability, and that drives down into the business's KPIs as well. So what Naresh is driving is also what the sales director is driving and what the procurement team is driving. It's all consistent in terms of the outcomes they're looking to achieve.
If I reflect on a conversation I had with a woman who runs a shared service center, some of this was around transparency. So for the Treasury team to say, okay, the way we're interpreting the policy, the strategy means we want to manage payables and receivables differently. Being told that, being made clear, these are the KPIs we're operating under, she found incredibly valuable. What she really hated was being kept in the dark. And that's also tone from the top, being transparent around the KPIs. If the KPI is in conflict, that's not disastrous, but we need to know that. And the worst situation is when we're not aware of it, and I'm just in my silo driving my own behavior and my own team's behavior, and sometimes undermining what the rest of the business is trying to achieve and working hard to do.
Naresh, we're talking about this almost exclusively as if it's a people thing. With the amount of technology that there is in the business now to make some of these things transparent, easier to manage, does technology solve some of these problems?
The best technology in the world is not going to make a better relationship between me and another part of the business. If I have perfect oversight in real time of what Rowan's doing and I'm constantly on his back, I don't think that's going to be a very productive relationship. The challenge with technology is often it's a distraction of what we're trying to achieve. Work out what your problem is. Work out where the challenges are. And then if we need to use technology, use technology. If an Excel spreadsheet is good enough, use an Excel spreadsheet. If you need the latest treasury management system because of X, Y, and Z, get the latest TMS. But one organization I know that put in a TMS, it cost them about £3 million. The scope of it was phenomenal, and I'm sure the board thought it was going to make the T. It didn't work very well when they upgraded Oracle. It was almost impossible to upgrade this TMS. They got a new treasurer who went for a £30,000 solution, which did the 6 basic things he needed it to do.
I think the lesson we've all learned from technology across our careers is don't try and automate rubbish processes.
Right.
Otherwise, you just get quicker processes that are still rubbish. Technology can be part of the solution, but it's not the only solution because we all operate still in people businesses where we need to collaborate to actually get the right kind of outcome. We're clearly in a hugely advancing technological world, and how that's having an effect on physical supply chains, I think, is really important in terms of how businesses trade, how they can manage and mitigate cross-border risk. I mean, we talked a little bit earlier, Naresh, about cash flow forecasting.
Yeah.
We're seeing AI-based cash flow forecasting become much more prevalent, and it's really changing the world in terms of how companies look at their cash flow forecasting, and that's a key role of the treasurer. But that's now also leaning into AI-linked supply chain management. So looking at how you can map your supply chains and how you can manage that supply chain and identify some of those key points of failure and how you can then manage that in terms of the risk. Supply chain management is becoming much more professionalized as a result, and technology is helping that. So it's about predicting the potential impacts and how that can be managed, and also looking at forecasting supply and demand. So that's a really important part of the business. That's the commercial side of the business that typically looks at supply and demand and how that's managed. But then that has an impact on the financial resources of the business, which is Treasury's role. As Naresh said, if you're suddenly going to find a lot of new customers in new environments, how do you let Treasury know? How can they then predict that? How can they then work with the banks and their other partners to look at the financing they need to support that?
The thing I think that is transformational is the volume of data that is both available and potentially accessible and to some extent needed by other stakeholders. At the ACT, I spent quite a lot of time on this, things like ISO 20022, the need for Scope 3 sustainability reporting in a world where actually the data is probably the most critical part of what we're doing. And that the technology question is, how do we harness the data to deliver the objectives? Because we can now include within payments, we know a huge amount of data compared to before. We can structure the data in a way that makes it easier to manage AML risks, sanction risks, so all these things that are now far more front of mind and getting it wrong, much more impactful. The opportunity to do it better is there. And I think the pace of technology means that the cost of implementing some of these solutions is also more achievable for not just the FTSE 20, but for a much greater range of organizations to deliver. And I think that's one of the roles that we should be getting as treasurers from our banks. We should be understanding how can we manage our data to address a whole range of quite disparate stakeholders and requirements. If we're lucky, maybe you've got organizations you recommend. Like a lot of these things, it's where do I start? And sometimes you can be paralyzed. Do I start looking at sustainability reporting requirements, sanction reporting? Which of these things is my starting point? And I don't know which one is right and which one's most urgent. There's a real role to lean into the money that organizations like NatWest have put into this, to lean in the expertise, the insights, the client experiences to help treasurers get a better handle on how it's not just the role of the treasurer, but I also think we are in a privileged role where we can say to the C-suites, we've spoken to NatWest, this is how they think we could be managing all of our data or a large chunk of our data. This is how we could be using it with some of our ERP or solutions. It's not my job. I don't want to be a project manager for this data project, but we can lean into the expertise and the insights from these organizations and the work they've done already.
Scott and Aastha are at the beach. However, I'm going to ask you one question that I always ask them. What do you have on your radar? What have you seen? What are you thinking about that maybe not everyone's talking about yet? Rowan?
I've got two, if I may. Tim, is that all right? Or is
As
that
you're
cheating?
a special guest.
First, we are hours away from Liberation Day Mark II.
At time of recording.
At time of recording. That's the implementation of the higher level of Trump's tariffs, pending any new deals that might be announced in the meantime. Those that haven't agreed deals will be on the higher levels that were announced on Trump's Liberation Day. I really think we've not yet seen the impact of those tariffs wash through to corporate behavior and the market impact. So the next 6 months is going to be really, really interesting in terms of seeing the impact on physical supply chains and how the wider economic world is going to manage that. The second is the news last week that the share of goods as a proportion of UK exports has fallen to a record low. Goods exports is now about 41% of total UK exports, so services makes up the rest. That's down from about 2/3 from the year 2000. While not great news at the high level, the outset, because we're keen to drive export trade, and that's fundamental to what the government's looking to do to drive the UK economy. It also highlights the increasing proportion and importance of services to the UK economy and exports of services. And that plays to the British strengths as a service-based economy. And the point is that tariffs generally hit physical goods rather than services.
Aastha's very keen to talk about services, and I think we should give her the chance in the very near future. Naresh?
I'm going to redefine the question. Sorry.
Honestly.
And,
no, go ahead.
And you allowed Rowan a couple of things. So when I speak to treasurers, the things that I think they are aware of, but not really doing much about, one is trade digitalization. They get it and they can see the benefits. And the fact we have case studies that demonstrate the real benefit, but somehow it's not cutting through to how organizations are adopting it. And I think there needs to be greater efforts around treasurers and businesses to really understand what the opportunities are from what we have done in the UK as one of the first countries to pass legislation. And the other one, stable coins. How stable coins, digital assets, and the broader crypto ecosystem operates is something which I think a lot of treasurers have some casual acquaintance with, but haven't really done any great detail and analysis on what it means for their businesses. And I'm quite cynical around a fair chunk of this. There is still a lot of froth, but at the heart, there is a lot of stuff going on. And I do think that treasurers need to be much more informed, because I think there's still quite a lot of prejudice about this is all about Bitcoin, it's all volatile, and it's all rubbish. And I don't disagree with any of that, but I do disagree that this is all about Bitcoin.
Delighted to have both of you and to be able to talk to you. Thank you, Naresh.
My pleasure.
And Rowan as well.
And thank you, Tim.
Scott and Aastha are back next time. If there is something you want us to discuss, please let us know. We read everything and we take notice of everything. If you like what you're hearing, please tell someone else about us and leave us a review as well. We better get back to the news. Thank you very much for listening. We'll see you soon.